A question that I often receive is which REIT do I prefer, Realty Income or W.P Carey? Both of these REITs are highly popular among individual investors and there are good reasons for it. They both have multi-decade track records of significant market outperformance, beating even the S&P 500. They've both also historically offered high and growing dividends during most times. And then thirdly, they both have strong investment grade rated balance sheets and earn very consistent and predictable cash flow from long-term leases with over 10 years left on them. And then finally, despite all of this, they've recently seen their share price crash, and as a result, they are today priced at historically low valuations and high dividend yields of over 6%. But which one is the best to buy today? Hey everyone, this is Yusha. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to give you 3 reasons why I believe that W.P Carey is a better investment opportunity than Realty Income. But before that, I want to thank all of you who've donated to a recent campaign to help Ukraine. Initially, our goal was to raise about $40,000 to buy 2 trucks that will be donated to military units in Ukraine who need them the most. But by now we are already over $100,000, which should be enough to buy about 6 trucks. So that's amazing. Thank you so much for your generosity. If you want to learn more about our cause, I'll put a link to it in the description of this video. It's not too late to donate. Whatever money we get will simply buy additional trucks to these military units. And in a month from now, I'll publish a video on this channel of us handing over the keys to these military units. I'm sure you'll be very proud to see this video, knowing that you participated in the donations. So please give it a good consideration. Thank you so much. So the first reason why I prefer W.P Carey over Realty Income is that it has a superior asset base. Realty Income owns mainly retail-based net lease properties, whereas W.P Carey owns mostly industrial-based net lease properties, and I don't really have a strong preference between one or the other. Both can be strong investments. However, if I had to pick one, I would go with the industrial properties because they enjoy 2 major trends that should lead to stronger demand and faster rent growth over the long run. And these are the growth of e-commerce and the growing trend of nearshoring and onshoring. These mega trends are leading to rapidly growing demand for industrial space, and W.P Carey is well positioned to capture strong releasing spreads over the next 5 to 10 years as its leases gradually expire. Net leases are typically very long and only include limited rent hikes, and therefore I think that some of the leases of W.P Carey will have likely fallen deeply below market rents, and therefore this position it well to capture some additional growth as leases expire. I think that Realty Income's retail-based properties will also do well and also enjoy relatively good releasing prospects, but perhaps not quite as good as those of W.P Carey. Then the second reason is that I think that W.P Carey will enjoy better growth prospects over the long run. Net lease REITs really grow in 2 main ways. Firstly, they enjoy contractual rent hikes in their leases, and then secondly, they also grow by acquiring additional properties. And I think that W.P Carey is superior to Realty Income on both of these. Firstly, concerning the rent hikes, W.P Carey has mostly CPI-based rent adjustments in its leases, and this is resulting in faster rent growth in today's higher inflation environment. Last year, its rent hikes were over 4%. This year, they expect it to be closer to 3%. In comparison, Realty Income has mainly fixed rent hikes in its leases. It also has some CPI-based leases, but typically they are capped relatively low, and therefore last year its rents grew only by about 1.8%, so less than half of that of W.P Carey, and this year again W.P Carey will be growing its rents a lot faster than Realty Income. And then concerning property acquisitions, both REITs have roughly the same cost of capital. They're earning roughly the same cap rates today. W.P Carey has a slight advantage on the cap rates if you look at the average of the past 3-4 quarters, but it's really not a material difference. However, W.P Carey is a lot smaller in size than Realty Income, and this is always an advantage for external growth. Even then, I still expect Realty Income to grow faster than W.P Carey in 2024, but this is because of temporary reasons. First of all, Realty Income is benefiting from its recent merger with Spirit Realty Capital. This is a one-time event. And then secondly, W.P Carey is still in a transition year as it's selling a lot of its office net lease properties and reinvesting these proceeds into other assets. It's leading to some bumpiness in its FFO per share. And then the third and perhaps most important reason why I favor W.P Carey over Realty Income is that I think that has a stronger catalyst to unlock value in the near term. What's important to know here is that W.P Carey has gone through a major transformation in the recent quarters. It sold most of its office properties into a separate REIT, and then it retained some that it's also selling individual in the private market. and it used this as an opportunity also to cut its dividend, to adjust its payout ratio to a lower level, to retain more cash flow, to boost its organic growth prospects. All of this hurt its market sentiment tremendously because nobody likes a dividend cut, obviously. However, going forward, I think that this transformation is going to unlock a lot of value for shareholders because right now, yes, its market sentiment is suffering because everybody is focusing on the dividend cut. But if you look a few years down the line, I think that people will realize that W.P Carey has now become a quasi-industrial net lease REIT with strong growth prospects because it's retaining a lot of capital. It's also a lot safer. And as people realize that this has now become a quasi-industrial REIT, I expect the market to reprice it at closer to the industrial peer group, which today is priced at 20 to 25 times FFO on average. Companies like Prologis are trading at about 20 times FFO. I don't expect W.P Carey to trade at 20 times FFO, but I think that it will re-rate closer to this new peer group, and just getting to 16 times FFO would unlock about 30% upside while you wait to earning a 6% dividend yield. I don't think that Realty Income has as clear of a catalyst. Its peer group hasn't changed, it hasn't had any major transformation, and so I think that W.P Carey is likely to enjoy stronger appreciation and multiple expansion than Realty Income in the coming years, and this is really the main reason why I expect it to outperform going forward. So to conclude, if I had to own just one of these REITs, it would be W.P Carey, and we own a position in it in our retirement portfolio at High Yield Landlord. If you want to access the full portfolio, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. Otherwise, if you thought that this content was valuable, please click the like button and subscribe to the channel. That helps me a lot. Thank you so much and see you at my next one. Bye-bye.